Hello and welcome back to the channel Implied Investing. Today we have a good one. We're going to be reviewing DDDD, which is YieldMax US Stock Target Double Dividend ETF. But before we get into that, let me go ahead and give the disclaimers that this is not financial advice. I am not a financial advisor. This is for education and entertainment purposes only. Before making any financial advice, before making any financial decision, please go seek out a qualified financial advisor. Now, with that out of the way, let's go ahead and jump into this review. So, one thing I want to point out is that this fund is probably going to do well. What I think it's going to do, I think it's going to do well, but I truly do hate that YieldMax came out with it. If Neos came out with it, if Tapping Alpha came out with it, if uh, S- Amplify came out with it, if Curve came out with it, it would be so much better. But YieldMax came out with it. Um, it's an interesting strategy, and we're going to go ahead and review it. But just knowing that it has that Yield Max title on it, I typically don't like reviewing their funds because they are known for driving funds into the ground. But we'll check this one out, and I'll let you know later on how this might be able to fit into a portfolio. Okay, so this is DD4D, the fund. It is a clone of SCHD that promises double its distribution. Right now, its stock price is about $30.33, which is very similar to where SCHD's is. It's trading at a slight discount to the NAV. As you can see, the NAV is at 30.35, so it's tracking pretty good. It's targeting a 6.9 distribution rate, which is double what SCHD has. I think SCHD right now is at 3.45, likely to change. And it is the third week in March. So SCHD is probably about to do its annual reconstitution. It has a pretty high expense ratio, a very high expense ratio of 1.01%. It distributes quarterly. It's not a weekly payer, it's not a monthly payer, it is a quarterly payer. So it's on the same schedule as SCHD. And it's very, very young. Fund came out, well, when I made the PowerPoint, probably came out, it came out exactly 8 days ago. So with that out of the way, oh, and it has a very small AUM of just 3 million, but mind you, um it's only 8 days old. So that I'm confident that that will grow. Okay, so let's take a look at the strategy. So I said DDDD is a clone of SCHD. And here's how it makes the money. So it has the dividend income. It buys the actual stocks inside of SCHD, and it collects real quarterly dividends from those companies like Chevron, Merck, Verizon, and Coca-Cola. For those of you who don't know, SCHD is a dividend grower. It picks blue chip stocks that have a 10-year history of growing their dividend, and it screens them, and it has targets as to how much each sector can be within the fund. Now, the second part is the options part. It sells credit call spreads against individual holdings to collect additional premium income. So I know if you listen to me before, you know what a put credit spread is. A put credit spread is you betting that the market will not go below a certain point. A credit call spread is you betting that the market will not go above a certain point. And when I say market, I mean in these individual stocks will not go above a certain point. And that is how it works. You buy one closer to the money, one above the money, and if the market goes into breaks your strike price, it depending on how far apart your spreads are, you may owe something. So that is how the credit call spreads work. It's not a traditional covered call where you're capping your upside. For this, these are smaller bets. You're not betting blocks of 100 um, of the individual stock. You're making smaller bets that are capped, that have defined risk, not capped. Okay, on to the next slide. So what makes BDDD different than SCHD and other funds? It writes over the actual holdings, right? So it holds those actual stocks. It has a diversified overlay, and this is something that I thought was really, 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 really interesting. So the option spread across 27 names with multi-tier strikes, unlike single stock yield max funds, where one blow one where it's 100% capped, where one blow up can kill the strategy. This has multi-tiered credit call strike prices, and one company that you know who does this tiered level of uh, strikes is Neos. That is why their funds operate at such a high level, and that active management is a very important part of it. The question is whether or not YieldMax, who are known for running funds into the ground, can actually execute this strategy, and we'll see. Only time will tell. So they have a multi-tier spread approach. 10 holdings have two spread levels at different strike price for more granular premium capture and risk management. Double distribution target aims for 2 times SCHD's yield of 6.9 versus 3.45. The first YieldMax double distribution family. So they do plan to come out with several of these. I imagine that they're going to do Vanguard's version of dividend growth. They're already doing SCHD, and they'll probably do a couple more of the more popular dividend growth ETFs, but just double their dividend. But I think the real takeaway here is that the credit call spreads, they're doing a tiered system so that they can capture more and more premium. All right, on to the next. If you're familiar with SCHD, then you know some of its holdings, but here's something interesting. They don't just hold SCHD's holdings, they hold SCHD itself. At almost 20% of the fund is regular SCHD. So you're getting that methodology that SCHD uses to pick its stocks, but you're also getting the single stock underlying holdings. ConocoPhillips at 5%, Lockheed Martin at basically 5%, Chevron 5%, Verizon 4%, Bristol Myers Squibb 4%, Merck, Altria, Texas Instruments, Coca-Colas. These real blue are very blue chip, salt of the earth type companies, and they're writing uh, credit call spreads on top of them, just betting that hey, these will not go above a certain point by the end of the day. And we'll dive into how long they write their strikes out for in the option section. So this is the breakdown of how SCHD is built. One thing you'll notice is that it's very light in tech. And if you have been in the market for the past 5 years, 5 to 10 years, you know, tech has been on a tear, and SCHD largely got left behind because um, it wasn't invested in these areas. Now that because of the certain geopolitical events in the Middle East, uh, this fund is likely to do well because it holds 20% energy. Now, what I have heard is that during the reconstitution, the fund is likely to sell off some of its energy, probably go down to about 50%, and buy into financial services. I think that that's probably the worst time to switch out of energy is right now, but they stick to their methodology and we'll see how it turns out. Okay. Um, the options income overlay. So after looking at their options, this is what we found out. They have 37 total spread positions. They write them about 30 days out. When I pulled this, it looked like that there were 26 days left before they would have to roll these positions. All 27 equity positions have credit call spreads on them. No naked options, no synthetics. 10 names have two spread levels at different strikes for multi-tier premium capture. 22 of the 37 positions are 6% out of the money. So they are writing these calls very conservatively. Now, one of the strikes on CVX was in the money already at 0.9%, and EOG was very close to the money at it was 0.9% out of the money. If the market goes up, it probably will be in the money. But as of right now, I don't know if you guys saw what happened Friday, but most of these strike prices are probably safe and out of the money now. So they just need to hold that position for 26 more days. Okay, moving on. This is about how much premium that I've estimated that they have collected from those. options positions that they've taken out. The options annualized, they need about $130,000 estimated annual dividends from actually holding SCHD and those other holdings. Those individual stocks is 96,000. Cash money market interest about $1,300 because it is options based fund. They do hold a certain amount of the fund in T-bills. Annual distribution obligation is $209,000 at 100 shares times $2.9 a share at 6.9% on a $30 NAV. Key caveats: the options premium varies during market volatility. Low VIX equals less premium. So the takeaway here is that it looks like they can make their targets of 6.9%, and just the premiums that they collected this month is enough for 1.09% of what they would need to pay out. So they have a little bit extra. I don't know how YieldMax banks that extra money, or do they just give it all out? But I hope they bank it for times when they may need it so they don't have to dig into the NAV to create the premiums. And here's how the fund compares to other funds in its category: JEPI, Devo, and SCHD. So DDD has the highest expense ratio of all of them. Devo coming in a quick second. Its distribution rate is very competitive, very competitive. It's actually higher than Devo's. It's actually higher than Devo's, and it uses call credit spreads versus JEPI that uses ELNs, and Devo, which uses selected cutter calls, and SCHD, which just a pure dividend factor. It does release its earnings quarterly. I know a lot of people like monthly. I'm not a fan of quarterly. I'm not a fan of quarterly. It takes too long. And if you're in retirement and you're planning your bills, it's easier to plan them if money's coming in monthly versus trying to plan how much you think you're going to get 3 months out. JEPI is monthly, Devo is monthly, SCHD, as everybody knows, is quarterly. And I thought that this was a very, very interesting slide because if DDDD was by a different, if another company sees how successful it is, and like the people at Devo, if they see how successful it is and decide to make their own version of DDDD, I think that that fund would be very, very popular. I think it would be very popular, especially if it paid monthly and it had the same holdings. A lot of people use Devo as a sort of higher yield monthly version of SCHD. I do think that there still is some space in the arena for a fund like that. So, but they would need to bring down that expense ratio because that expense ratio is very high. So that's how it compares to funds kind of in its category. And I wanted to show somebody this chart. I worked on making this chart because I think it's important. SCHD has a lot of fans. It has people who are already invested in it, but this shows you your annual income and your cumulative income on $100,000 investment. And what one thing I want you to see is that DDD is in the red while SCHD is the yellow. So it's going to, with $100,000 investment, it would take SCHD 20 years before SCHD is paying you more than DDDD. It would take 20 years for that crossover to happen because DDDD starts off with a higher yield. So it would take 20 years before it beats you. Actually, 20 years and some change. Just as you can see, it hasn't quite beat it on the 20-year mark. Now, that's 20 years of DDDD paying you more than SCHD is. For cumulative income, cumulative mean how much money it would pay you, how long it would take for SCHD to pay you more than DDDD. Look at that chart. It would take almost 35 years. 35 years because they have that 20-year head start of paying you that 6.9% yield. It would take cumulatively 35 years before it beats you. And this is even with SCHD's dividend growth component. And because DDDD has a tad bit of, it has 20% SCHD, it also has dividend growth. It doesn't have as much, and it holds the underlyings that SCHD has that grow their dividend. So it's receiving a pretty hefty portion of dividend growth. And because they're not doing covered calls, they're doing call credit spreads, it has room to grow. It's not just automatically capped out. So I wanted to show everybody this slide before I went too far. And this is why I say I wish it was somebody, any fund other than Yield. Oh, not any fund, but I wish it wasn't YieldMax who made this because, honestly speaking, in 35 years, I don't think YieldMax is going to be around. I really don't. I do not think YieldMax is going to be around in 35 years. I think that in 20 years, depending on whether or not they make substantial changes, the SEC might shut them down. If a different administration comes in and sees what they're doing, they may come in and shut them down. So that's just something to think about on a human time frame. Now, if you're trying to build generational wealth, that's one thing. But on a normal human life time frame, especially if you're in a rush, um, DDD is looking really good, but it's by Yield Max, so it's an automatic pass for me. Automatic pass. So 5 reasons to buy DDD. If you love SCHD and want more income, try DDD. Diversified options writing. It is not using cover calls. It's using credit call spreads, which don't cap your upside as much. It's safer than synthetics. Most Yield Max funds use synthetics that decay over time and lose their ability to track the underlying. It has a growing AUM. It's grown 33% in 8 days, but mind you, where they started from was absolutely tiny, which is 75,000 shares. It moved from 75,000 to 100,000 shares. First mover advantage. They're the first people in this space who are actually cloning SCHD and using an options overlay. Devo, like I said, is a substitute that some people like to use for it. I know I did for a little bit, but if you're looking for that safety, that low volatility, that blue chip exposure, this may be something that you're interested in. Reasons not to buy, it does not have a track record. We don't know how what type of dividend growth um this fund is going to have. We don't know. We know what SCHD does, but we don't know the type of dividend growth. Mathematically speaking, it should have 20 to 25% of the same dividend growth because it holds the underlyings and it also holds SCHD, but we don't know. Some of their spreads are already in the money. That's bound to happen when you're running an option strategy. It has a very high expense ratio for the type of like this type of expense ratio. I expect that out of a fund like um tapping out like PDAC because they're writing cover calls every day. Or I expect that out of a fund like KYLD because they're running 10, 15 different strategies on 30 funds trying to squeeze out all the volatility premium that they possibly can. But this is a high expense ratio if you're just running credit call spreads 30 days out and you're rolling. This is a very high. It has thin coverage ratio. Because it's low, um, because there's not a lot of trading on this fund yet, you being able to get your it's going to have wider spreads. It's going to have wider spreads than you may be traditionally used to. So that is my review of DDDD. This is my deep dive. It's a lot of D's, but should have said this in the beginning. Please like, subscribe, hit the bell notification, and leave your questions in the comments. I hope you guys are having a blessed day. I want to know whether or not you're going to use this in your portfolio. I'm not going to switch over to it. I'm going to wait for another fund to pursue this strategy and then I might get it. But I have a small portion of SCHD. It's not something that I'm depending on. It is in my long portfolio. It is not a part of my income portfolio whatsoever. But if you're not averse to yield max and you have some faith in them, I don't. I personally I think that they're going to run every fund that they get their hands on into the ground. I know that's not what they've done historically, but that's just how I feel about it. Anyway, you guys have a blessed day. Let me know how you're using this fund and if you're going to get it. And I will talk to you all later.